Insiders, corporate insiders, have sold more shares last year than ever before in the history of records. So the insiders are already out.
Here at Liberty and Finance, we're licensed brokers with Miles Franklin. We are standing by the inventory, ready to make sure you get what you need, even into the wee hours of night and on weekends, because preparedness doesn't stop. Call us 1-888-81-LIBERTY. That's 1-888-815-4237. Welcome back to Liberty and Finance. We're always delighted to have this returning guest. Michael Pento is the founder of Pento Portfolio Strategies. He's an active money manager, and he joins us this Friday, January 28th, 2022. Michael, thanks for coming back on Liberty and Finance.
Always a pleasure to be with you, Dunnigan.
We always have a lot more questions submitted prior to your arrival than we ever have a chance of fielding while you're with us. And in fact, I think you told me about a year ago when we had you on, and it had been several months at that time. And we said, what are we going to do? We get disconnected. You said, well, you're going to have Michael Pento back on more often. So we've been trying to, and our viewers always appreciate that. They are looking for, because a lot of people are trying to position themselves to be in a safe spot or the best spot, or to be both potentially able to thrive and survive the major changes that are coming in. A growing number of people consider that the changes may be more volatile, bigger in nature, that may be coming soon. We've certainly seen a lot of that in the last couple of years. So could we first turn our attention to one of the areas that people look to for clues about what may be happening next, and that's the Fed's actions that can affect monetary policy, it can affect interest rates, et cetera. You've been watching that closely as well. We just had a FOMC meeting, and what are you seeing that you think is important that people need to understand about the outcome of that?
Well, I think a lot of people were anticipating a very dovish Mr. Powell. And I heard a lot of people, especially people in I call them the deep state of Wall Street, these wirehouses, the JP Morgans of the world. Powell could never raise interest rates, could never do this. He's got to be dovish because he'll destroy the stock market. Well, and this is the way I was thinking about it. I said that's completely ridiculous. And here's why. So Powell spent all of 2021 telling everybody that inflation was transitory. And inflation waxed higher and higher throughout the year. And then in December, we had a print of 7% year over year consumer price inflation. And it was that December print, along with other factors, of reducing unemployment rate, that caused Powell to become very hawkish. He said we're going to accelerate the taper, and we're going to be raising interest rates in 2022. So he did that pivot. So a month later, the FOMC meeting in January comes out, and people were telling me again that he's going to turn to a dove. And I'm saying to myself, wait a second. There's been no new information about inflation officially from the Bureau of Labor Statistics, Department of Labor, whatever. None. It's still 7%. And energy prices continue to go higher, along with wages and home prices and owner's equivalent rent. So how in the world? I mean, Powell would look like a schizophrenic monkey if he was to say, oh, you know what? Maybe inflation is transitory, and I don't have to stop QE, and I don't have to raise interest rates. So he said exactly what I thought he was going to say. But here's the thing. Now Wall Street is, tripping over themselves to get positioned for rising inflation and rising interest rates. And they seem to be always behind me. I mean, I've come on your program. I'm a regular guest. And my track record is very clear for everybody to see. I said last year, in the middle of last year, beware of Q1 and especially Q2 of 2022. I mean, just based on year-over-year base effects with inflation and growth. I said inflation was going to slow a little bit throughout 2022, but more importantly, growth was going to decelerate. And that's exactly what's going to happen. And I said, beware of this first half of the year, especially the second quarter, because I think we're going to have a very good chance of a crash. And by the way, we've had a crash already, and I think it's just getting started. Now, let me be very clear. We've had a crash. I think February could still be a rebounding month, or at least a plateauing of asset prices. But once we get into the second quarter, so let's just be specific, please. Understand that in March, we're going to have the first rate hike. And then we're going to have in the second quarter, sometime in the second quarter, so April, May, June, we're going to have the second rate hike and the beginning of the draining of the balance sheet, which I believe is going to be about $90 to $100 billion a month. Powell said he wants to have mostly mortgage-backed securities out of the portfolio. So he just wants treasury. So right now, the Fed has $2.7 trillion of mortgage-backed securities that it has to dump expeditiously, which is going to cause interest rates for homes to skyrocket, in my opinion. And you're going to have the same thing. And I'll leave you with this, and I'll let you in on a question. Then again, he said, this is what makes me laugh. So Powell said in his FOMC conference meeting that, we're going to have the draining of the balance sheet just run in the background. Well, the last time they did that was 2018, 2019, when the market just absolutely crashed. So we're in for another very, very difficult time in the stock market. We've been through one already. I think it's just getting started. And I would just want to say one more thing about my portfolio. I came into 2022 with some shorts in the portfolio as a buffer, and that is why we're doing very well here at the Pento Portfolio Strategies with a minor loss in the portfolio, as compared to 14% down on the NASDAQ and 9% down on the S&P.
You've got other people besides yourself that are watching things roil and roll and wondering if we're going to see a big turnover. Actually, I've got a question in each direction here. One person talking about if there are opportunities that present themselves from that, what risks might lie within those opportunities. I remember when I was a kid, I would always play checkers, and I'd always think I was setting up a double jump, and I'd end up getting double jumped. So TM8155 is asking, since refinancing is available with a 15-year fixed rate at 2.75%, a loan equity ratio about 50%, what kind of risks might be overlooked if it's refinancing to pull out cash, to raise cash in order to take advantage of a potential drop in precious metals and our real estate prices? So for people who are thinking, gee, I got to gather up a lump of cash here because I feel like there's going to be some opportunities coming either in low metal prices or in low real estate prices. But if they're using their own home as the equity to pull that out, what hidden risk might people need to be thinking about?
Well, the hidden risk, first of all, I can't recommend anything for this individual because I haven't done my due diligence on it. But just for a rule of thumb, it's never a good idea to take money out of your house to invest in the stock market. I mean, I just don't like that trade, especially when I think that real estate is in a echo bubble. There's a triumvirate of bubbles out there right now, as you know, real estate, stocks, and bonds. So you're speaking to someone right now who's actually renting a house before I go and buy a house, because I did this before in 2005 and 2006 when I sold some property I had in Florida, Sarasota, because I knew we had a bubble in real estate back then. So I'm doing the same thing now. So I'm deferring my purchase, because I think we're going to have a very big problem with real estate mortgage interest rates in the very near future, as I just went through about the Fed dumping $2.7 trillion of commercial securities. But so when you talk about the interest rate complex, you have to be very specific. So I do believe that short-term rates could rise a little further. Long-term treasuries are in a topping process, in my opinion. Because as I said before in this, to answer the first question, the Fed is always fighting, the last war. I mean, now they're going to start to fight inflation. Now they should have been starting inflation years ago. I mean, right after we had a vaccine come out, that was a great time to end quantitative easing. But they kept up $120 billion a month for way too long, many, many, many quarters too long. And we won't even talk about with Ben Bernanke, he wrote a book about the courage to act, the courage to destroy the middle class is what the book should have been called. So I'm looking for treasuries long-term treasuries to act a lot better and a lot different than junk bonds in commercial CMBS, commercial mortgage-backed securities, and residential mortgage-backed securities.
The other side of this is people are concerned about the potential for a meltdown in the housing market. Chris asks, what is your outlook for the global housing market when this thing blows? How far down will it go? How will the World Economic Forum, quote, own everything? Any thoughts on this?
I have a lot of thoughts on that. Like I just mentioned to you, I'm deferring a purchase on a home. I think home prices could very easily drop 20% in the United States. I'm talking about worldwide. I'm not a student of every single housing market, but certainly, you look at the problems they're having in China with their massive fixed asset bubble. That's unwinding. I don't care if Xi Jinping lowers, the triple R lending rate. He's not going to be able to prop up that bubble much longer. So, I think that as real estate prices come down, along with the stock market, people who have overextended themselves, again, owning multiple homes with very little money down. It's not quite as bad as it was in 2005, 2006, but it's an echo bubble. They're going to be in a world of hurt. So if you can, I would hold off on purchasing a home until home prices correct.
You mentioned a few minutes ago about the I don't know what to call it, the letting the paint dry. Is that what they used to call it at the Fed here?
So it was both. Yeah, it was running in the background or watching paint dry. That's what they tried to convince investors. That was the dynamics behind quantitative tightening. Didn't quite work out that way. And when they did that before, which was 2000 to 2018, 2019, Fed's balance sheet was nowhere near where it is now. We're at $8.9 trillion. But before 2008, it was $800 billion with a B. Now we're 8.9 with a T, trillion. And Powell says he wants to, and I'll quote him, there's plenty of room to significantly drain that balance sheet. Never used words like that before. So, I warned people on your program. I said, watch out for 2022. I hope they listen to you. I hope they listen to me. They have another chance of a small rally here before we get to March, April, May, and June, because that's when I think the real poop hits the fan. So if you haven't already raised some cash, you should use any bounce to do so.
We have a question here about how much can we trust? Like we've talked in the past about whether the headline CPI numbers are reflective of what's actually going on in the real economy, et cetera. Dadbod Way says, is the Fed really reducing its asset purchases? Balance sheet seems to say yes, but what about off balance sheet? Is there anything that is knowable about off balance sheet actions by the Fed?
So just to be specific, the balance sheet is still increasing. The rate of change is slowing. Okay, so it's growing at a slower rate, but it's still growing. It's not going to shrink until probably May. Off balance sheet, who knows? What you do know and should be aware of is this balance sheet is going to come down faster and harder than any time before. And they only tried to reduce the balance sheet once, so it's not exactly an earth-shattering statement. But it's going to come down to the tune of trillions, not just a few hundred billion, trillions. That's the goal of Jerome Powell. It's not me saying it. It's not Dunnigan Kaiser. Jerome Powell wants to raise rates, aggressively reduce the size of his balance sheet into an economic slowdown, which is global in nature, and inflation, which is also going to come down, albeit more on the margin. That's a disaster for equity prices. And let me just say this: I run money professionally. I have some shorts in the portfolio. I'm not yet net short in the portfolio because of my 20-point model, which I created, rigorously backtested. I look at commodity prices. CRB index is still rising. You can't have a collapse in the economy when the demand for commodities is rising. So I want that to start to roll over. I'm looking at a lot of spreads, break-even spreads, LIBOR, OIS, BSBY, junk bond spreads. They're flashing yellow, but they're relatively quiescent up until this point. What I try to do is protect and profit from huge and significant transient declines in the stock market. So every little, sell-off, nobody knows. Nobody knows if this 8-9% drop in the S&P is the start of something very big, or if it's just a normal correction from a very overvalued stock market. I'll know because of my model, and that is when I'll get net short in the portfolio. It's based on data and math, not my emotions or a CNBS headline.
Tim Sandman asks, related to this, Michael, is there now going to be a final, quote, crack up boom until the market finally corrects?
There was somebody who emailed me. I don't want to mention his name, but I think I have my name in his head. He was on another program and he said that he predicted a 40% boom in the stock market before it dropped 80%. Well, I mean, it's pretty specific numbers that he's throwing out. What exactly would engender a 40% rise? And by the way, I don't know, maybe I don't know the duration. I don't know if he said it was going to be this year or next year. I don't know if he gave me any timing to this. I said I thought the second quarter, the first part of this year, and particularly the second quarter, could bring a significant decline in the stock market of about 30%. I'm almost there already, especially if you look at the disruptor stocks in the NASDAQ. Most of the NASDAQ stocks, I think the majority of them are down significantly since the start of this year. And I mean 30, 40%. So but a boom of 40% predicated on what? A massive fiscal and monetary drag on top of a stock market that is 185% of underlying GDP. Listen, God only knows, and I'm certainly not God. Anything can happen, but the odds of that happening are virtually nil.
Well, there's a lot of things that have happened in the last 2 years or the last couple of decades that people think defy logic, defy gravity, defy conventional wisdom, defy proper fundamental analysis of value. So you're describing fundamentals about economic activity and that sort of thing. But if there is a concerted effort by the powers that be to pull out all the stops in throwing basically plunge protection at the market to make sure that it doesn't get a chance to really cleanse itself, that could continue to engender additional momentum riding, momentum speculation. By how leveraged are you've told us in the past, speculators, whether they're small retail or hedge funds or whatever, are how leveraged margin wise currently?
The exact figure slips my mind, but the total margin debt to GDP on the NYSE is an all-time record. Not nominally it's all-time record, but even as terms, percentage of GDP, it's all-time record. So there's a lot of room left on the downside. But again, as I talked about before, the idea that there could be some plunge protection team, it's still there. It's going to be called upon, but when credit markets stop functioning, when the repo market freezes and the standing repo facility gets tapped to the tunes of hundreds of billions of dollars a day, when you can't issue a junk bond anymore, when the commercial paper market dries up, that's when Powell will say, oh, gee, now I got a problem. Inflation's come down from 7 to maybe 5%. The stock market's down 30% on the headline S&P 500. Apple and Microsoft already pooped the bed, that's all I can say. But Apple is still doing pretty well and that's in every single ETF out there practically. When that finally breaks, then Powell will come, ex post after the crash. I don't want my investors to go through that. And by the way, there is no guarantee that the next time that the Fed and the Treasury turn dovish, that the market's just going to rip higher. I mean, it could, but you just can't start printing money and sending money out to people when the inflation is running at 2 to 3 times the acceptable rate of the Federal Reserve, which is already ridiculous. When the Fed says inflation is running at 7%, or the Labor Department says it's running at 7% year over year, you can best believe you can just double that. I'm more on the pre-Boskin Commission, mid-teens, the way you factor it into real inflation. So, I mean, do you really want to start sending asset prices higher and destroying the middle class at a faster clip just for the sake of rescuing Wall Street? Well, you might make that calculation, but at what point? It has to be not just the fact that stocks are down a little bit on the margin. It has to be some kind of dysfunction in the money markets. That will be my trigger to cover my shorts. Not until then, and that won't happen until the stock market probably drops around. Headline averages are down 30%. That's usually when, in the past, that has triggered a credit market event.
Well, I don't know. Some people are of the opinion that the bubble of everything that we're currently witnessing is a Frankenstein that was created by the money policies, whether they're on books or off books of those managing our money, our currency, and that in a sense there's a rotation away from middle class, earners, investors, baby boomers, that sort of thing, into those who are in a much more elite position. And somebody's got to hold the door open of the casino long enough for everybody who needs to get out at the right time before you let the whole thing come collapsing down. So it may not be just, not the only scenario is after a 30+% decline in the markets, but you could come up with a scenario where the markets appear to be flush after they shouldn't be anymore, so that those who need to can exit.
Well, you're exactly right. First of all, the first thing you said is it's not even debatable. I mean, the Treasury and the Federal Reserve has created a triumvirate of bubbles like has never existed before on the planet. I'm one of the first people to ever identify it and talk about it. Talked about it for years. But insiders have sold more. This is 2021. Insiders, corporate insiders, have sold more shares last year than ever before in the history of records being kept. So yes, the insiders have, for the most part, already dumped their stock. Think about it. Remember Elon Musk when he was selling, so the insiders are already out. So where are the other investors? Where are the Robinhood guys? The people I see on TV say, hey, let's start saving and investing. Well, that's a wonderful idea, but getting the timing right is essential. Because like I said, we could be in a situation where we look like Japan to 1989 or Shanghai Composite Exchange in 2007. Those indices still haven't come back. So I just don't want to have a reflexive thought that, hey, once the Fed becomes dovish, then we're going to just soar to new highs. Because the message you're going to be sending the bond market at that point, and the message you're going to be sending the currency at that point is, hey, we will never drain our balance sheet. We will never be able to fight inflation. And we're all in on creating these asset bubbles. Well, maybe that's true. But what interest rate do you ascribe then to junk bonds at that point? I mean, they're trading at the tightest spreads to treasuries ever. So unless the Fed is going to go out and buy everything, municipal bonds, corporate bonds, junk bonds, treasuries, maybe they will. Then you're talking about maybe we're looking more like Weimar Germany or the Hungarian pengo. At what point does the Fed say, listen, do we want to be a complete 100% unadulterated, avowed banana republic, or do we want to, try to get back to some kind of sense of normalcy? I think they try to get back to some sense of normalcy until chaos breaks out. Don't forget, the voting contingency of Mr. Joe Biden is mostly the lower middle to lower classes. They're the ones that are getting crushed by falling real wages. Real wages fell by this came out yesterday. Real disposable income fell by 5.8% on a seasonally adjusted annualized rate. And that's adjusting for the inflation. That doesn't really tell the whole picture. These are voting people. Why do you think Joe Biden's approval rating is so low? Because the people that voted him in place are getting destroyed by higher energy costs, housing costs. They can't even buy a house. They're renting. They can't afford to heat and cool their home. Food, it's gone through the roof. So, there is a calculation there. Like, what do I do? How do I placate the middle and lower classes and the 1%ers on Wall Street at the same time? Well, you can't do it. You choose one. Well, they've chose to defend, rightfully for a change, I believe for a very truncated period of time. But for a period of time, the Fed is hawkish. They will prosecute on their plan until the whole darn thing blows up.
Some people have been watching the yield curve for the last couple of years, especially looking for an inversion as a signal that we're entering a big time of change. Brent Peterson asked, did the yield curve invert?
Parts of it did. But now the 2-10 Treasury spread is now about 60 basis points, very low. It's coming down. So that's part of my model, the spread between the 10-year and the 2-year note. As that contracts, that's a signal that two things are happening. Inflation and growth are decelerating on a rate of change basis. That's what you have to know. So that tells me where I should be investing. So parts of the curve did invert, but very, very briefly and not very significant. I look at the 10-2 spread. That tells me when that inverts 100% of the time, it tells you a recession is nigh in the next few quarters. So we're not there yet. If Powell is going to raise interest rates 5 to 7 times, that's the base case scenario for most of Wall Street. All of a sudden they're saying that the Federal Reserve will raise rates 5 to 7 times this year. Well, with a 60 basis point spread between the 2 and 10-year note, I think that spread contracts and goes down. And that'll be one of the signals that tells Powell, hey, I've done too much. The stock market probably will be wiped out of that. Wiped out being 30% plus decline.
Another aspect that people have been watching with great interest in those last 2 years, when we heard originally about 40% of all dollars ever created were created in the last few years. Now, more recently, it was restated at 70 to 80%. So I haven't done the investigation to see why these numbers are moving, but the trend is higher in that statistic. Hood says, if inflation is a result of fiscal and monetary responses to the crisis, then why and how is the velocity of currency at all-time lows?
Well, I could spend a half an hour on this question. So first of all, dollars created. Define dollars. You mean physical currency or do you mean base money supply? If you're looking at base money supply, it's ballooned to almost $9 trillion. So it's up about 90%. But that's just base money. I mean, I don't know if you're mentioning M1 or M2 or M3. They don't even keep track of M3 anymore. They barely keep track of M2. When you look at the velocity of money, it's velocity based on the monetary base. Well, that's declining because GDP growth is slow, and you've increased the amount of the monetary base to such a huge amount, it's crashing. So that's telling me two things. The monetary base has been blown up to the moon, but the velocity of money is slowing because economic growth is slowing. And because it's slowing off a very, very large base, you get a lower percentage.
You've talked to us a couple of times, well, usually over every visit, actually, over the past year or so, about where you see the role of precious metals potentially playing in this whole scenario. There's a question here from EC660. He says, it's very easy to see the manipulation in the silver market, but just the last few days, it seems to be even more in your face with the so-called dollar strength forcing down the metals. What are your thoughts on this?
So you're talking to someone who actually increased their holdings of gold about two days ago. So I brought them up. And the reason why I did that is because everybody now is become, enamored with the position that the Fed is going to be very, very hawkish and raise rates 5 to 7 times in 2022. And the 10-year note yield's going to go to the moon. Well, I believe, I was the one saying that the 10-year note was going to the moon, which is why I sold gold. Now that everybody believes that it's going to the moon, I'm on the other side of that. I think nominal long-term treasuries will begin to top out if they haven't already done so. So I think nominal interest rates are going to fall, which means that I want to be a holder of gold. So I'm starting to accumulate more and more of the precious metal. And I've been on your show for years now, right? I've told you when I sold it. I've told you when I'm buying it back. I am now buying it back because we're starting to reach the point of peak hawkishness as far as long-term interest rates are concerned. So I'll be more of a buyer of long bonds, okay, rather than a seller into this panic, because the Fed. I just laid out the scenario very succinctly on this interview. The Fed can't move very far. They move 5 or 7 times this year. Well, 2-year Treasury note is already at 1.2%. So they're already pricing in, and the Fed funds futures market is already priced in 4 or 5 rate hikes. I think if the Fed does that this year, they'll invert the yield curve and the whole thing will unwind. And gold should sniff that out in the next few weeks or months, at the most, in my opinion.
Related question here from John Crookshank, who says, everyone seems to have gotten the silver price wrong so far. What's different this time?
Well, I'm one of those people who has not gotten the silver price wrong. I've told you over the years I've been on this program, I have not been yet a buyer of silver. I want to buy silver when the rate of inflation globally is increasing, because silver is a monetary metal. It's also an industrial metal. The last thing I would want to do now, I'm buying gold. I didn't say I was buying all precious metals. So, you have me on your program. You want me to be honest because you are a very honest person. And I'm telling you that silver is a buy after the Fed and the ECB and the Bank of Japan, well, they can't get any more dovish, but the PBOC, and they've started to become dovish. But I would like to see the Fed and the ECB become much more dovish than they are right now, which, if that engenders a period of global growth accelerating on a rate of change basis, then I would want to be a buyer of silver and gold. Until then, it's just gold.
Michael, if people want to follow your work, because you are on top of these trends in a forward you're looking at leading indicators, you're trying to position people so that whether things go up, down, or sideways, you got them in the right places. Where can they keep track of you and follow your writings and take advantage of your services?
So the website is pentoport.com. You can email me directly at mpento@pentoport.com. The office number is 732-772-9500. On the website, I record a podcast called the Midweek Reality Check. It's a free trial subscription for 5 weeks. It's $50 a year if you're so inclined to listen to me. And I give you a lot of good information from a high level about what I think the direction of the economy is, and what's the direction of interest rates, and what's the direction of inflation and growth. So if that's something you want to do, you have around $100,000 to invest, please reach out to me, contact the firm. There's an info button on my website. Listen, let's just end with this, Dunnigan. The days of buy and hold, it's dead. It's over. You're going to have more and more iterations of a collapse of the boom bust cycle. So the boom is, massive increase in asset prices, followed by very trenchant, steep collapses of the same, followed by more of a, attempt to reinflate things as we've waxed further and further away from a real economy. This is a complete artificial edifice that we've built, predicated on asset bubbles, debt, and interest rates that are just in the twilight zone. I mean, really, like junk bond yields at 3.5%, 4%. It's absolutely ridiculous. So if you want to be someone who says, I want to just buy and hold a 60-40 portfolio, stocks and bonds, you've been wiped out already. It's too late. But it's not too late. It's never too late to start doing the right thing. So get into an active management strategy, someone who has a robust model that can help time these, inflation, deflation dynamics.
Well, Michael, we are so grateful for your presence here always. On behalf of all of our viewers, just always glad to have you join us here on Liberty and Finance. And thank you for joining us this first time in January. It sounds like we're heading into an eventful year. We'd like to have you in our corner throughout that process. And thanks for being here today. My pleasure, Dunnigan.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, Simply call us, discuss your needs, and we will let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be double boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Elijah, my brother Kaiser, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.